Jim Uren's joining us now. Jim, investors love high dividend paying stocks. We talk about it on the show all the time, but there are some myths. What is the number one myth?
Yes, well, thanks for having me back. Yes, the biggest myth that we see is that a lot of people assume that dividend stocks tend to outperform the market overall. And although some research has initially suggested that can be true, when further research delves into that, we find out that that's not quite accurate. You see, dividend stocks, dividend paying companies tend to be a little bit bigger than others. They have a stronger balance sheet, higher profit margins, tend to have more stable earnings. And it's really those factors that tend to drive outperformance. And so when we separate based on those factors, what we find is that companies that pay dividends don't actually tend to outperform companies that don't over the long periods of time.
But dividend stocks do well during a bear market. Some people might think that, but even if they're not performing well, they're still paying a dividend.
They are still paying a dividend, and that's another one of the myths that we see a lot is that dividend stocks tend to outperform during a bear market. On the whole, that's somewhat true, but again, when we delve back and we dig deeper, what we find is because, again, dividend companies tend to be higher quality, lower risk firms overall, they do tend to do a little better during a bear market. However, when we separate out those other factors that we just mentioned, those companies actually don't do any better in a bear market compared to other similar companies that are also larger, higher quality, and the lower risk that don't pay dividends. And so, all things equal, what we find is that dividend paying companies don't actually outperform during bear markets compared to those that don't pay dividends.
Oh, I'm loving this. Okay, another big one. People think that dividends have tax advantages, but what's the truth here?
Well, somewhat true. So if you compare a dividend to a bond, let's say, yes, generally dividends are what are called qualified dividends. They usually get a better tax treatment. However, receiving a dividend still forces you to pay tax that holding a stock that didn't pay a dividend wouldn't force you to have to pay now. So all things equal, it's better to not receive a dividend because once a dividend is paid, the value of the stock that paid that dividend actually declines by the same amount as that dividend. So $1 dividend that you receive simply means your stock went down by $1. And so you're actually no richer off. And in fact, now you owe the IRS some tax money that you wouldn't have before if they had just kept that money in the company and not paid out that dividend. So all things equal, we actually prefer stocks that don't pay dividends compared to those that do when given the choice, because we then get to control when we realize those capital gains down the road.
Okay, I don't know if I agree with that, but okay, thanks so much. Thanks so much, Jim. Good to have you here.
Thank you. It's good to be here.